Let's discuss venture capital. Venture capital is a form of what we refer to as equity investment. To define equity investment, just think of the following scenario. A company is trying to raise money, and so an investor gives the company some money. In exchange for the money, the investor receives a portion of the ownership in the company, which we refer to as equity. In a case like this, typically the investor does not receive the money back in the form of a loan payment. An equity investment is an investment, and generally speaking, there are no interest rates and no structured loan payments or any method by which the company would pay the owner back other than the investor. And the investor simply owns a percentage of the company. And so if the company becomes successful, then the investor would participate in that success in whatever percentage of ownership he has. One of the questions before we accept money from a venture capital group is, do you really want an investor? Companies need to consider whether or not they want to allow outside investors to be involved in their business. And that needs to be balanced against the needs for capital in the organization. So this is an interesting question that many companies have to sort out before they begin talking to venture capitalists. By definition, venture capital itself is a process which involves creating value. So helping small and growing companies become successful. That's what we refer to as venture capital because it involves the application of capital resources in order to make this happen. Venture capital itself is a fairly recent activity in our economy. It's really only in the last 30 years or so that we have seen a great deal of venture capital investing in the United States. Venture capital is typically associated with an organization, not an individual person. So when we say venture capital or venture capitalist, we are usually referring to a partnership or an organization that is set up to invest money in small, privately held companies. There are several forms of venture capital organizations. The two most common are what we call private venture capital funds and corporate venture capital organizations. Private venture capital organizations are simply a partnership between people who have money and those who manage the money. Corporate venture capital funds are usually funded by a large company that wants to invest some of its own money, such as Intel, for example. And so if the company named Intel sets aside $1 billion to invest in other small companies, we would refer to that as a corporate venture capital fund. The way that a private venture capital fund is typically structured is as a limited partnership. Investors provide money, and when the venture capital fund goes through the process of raising that money, we call it raising a fund. Once the money is raised, let's say it's $1 billion, for example, then there are some partners, managing partners, that will actually do the work of finding good investment opportunities and investing the money in those companies, and then helping the companies that they invest in to grow and to be successful. The way that venture capital managing partners are compensated is as follows, and this is very typical of a private venture capital organization. Usually, the managing partners will take a fee of approximately 2% of the total value of the fund each year, and using that money, they will pay salaries to everyone who is helping them to make the investments. If a investment results in a profit, then the managing partners, get to keep 20% of that profit for themselves, and then the rest of the gains are distributed back to the original investors. Typically, this takes a very long time. If you are investing money like a venture capitalist, that means you are investing in usually small or growing privately held companies. Most of the time, these companies do not pay dividends, and the only way that the investors, the venture capital group, is going to get any money back out of the investment is if there is an exit. In other words, if the company is acquired or sold to someone else, or if the company becomes publicly traded, at which point the investors can then go sell their shares of stock in the stock markets. The venture capital industry actually began around World War II, but remained very small for a number of decades. Around the early 1990s, we started to see a great deal of investing activity by venture capital firms, and the number of venture capital firms increased rapidly. We reached a point towards the end of the 1990s where venture capital groups were investing around $100 billion per year in the United States into small, privately held growth companies. Following the 1990s, those levels of investment dropped and have fluctuated somewhat in the last several years. Venture capital groups, however, tend to be smarter and more cautious and a little bit more effective, maybe perhaps in the way that they are making their investments than they were back in the 1990s. There are certain industries which tend to attract a lot of investment dollars from venture capital organizations. The basic rule is if the industry has high growth rates associated with it, then it is an attractive place for venture capital to put their money. So, not surprisingly, some of the industries that receive the most investment from venture capital firms are software, biotechnology, and other forms of high technology, including consumer electronics devices, telecommunications, semiconductors, and those types of things. All of those industries have very high growth rates associated with them. A typical venture capital firm, a private venture capital firm, could be illustrated by, we'll just pull up an example here. This company's name is Kleiner Perkins. They are considered to be one of the most successful venture capital firms in the world. Kleiner Perkins has several venture capital investment funds that they manage. And some of these funds are in excess of $1 billion in initial investment money. Kleiner Perkins has been investing in computer technology companies and biotechnology companies for several decades. They have had a number of companies that they invested in initially that went on to become very successful, and then eventually they were able to exit because the companies either got acquired or were publicly traded so that Kleiner Perkins could sell their stock. Some examples are Google. So Kleiner Perkins was one of the venture capital groups that invested in Google. Amazon.com was one of their investments. Intuit, which is the company that produces TurboTax and QuickBooks and Quicken, was also a Kleiner Perkins investment. Kleiner Perkins also invested in Netscape and Sun Microsystems and Facebook and Twitter and just hundreds of companies that have gone on to become very, very successful. If you want to take a look at who is managing Kleiner Perkins and how the company is run, this is a quick look at their management team. So we're not going to go through all the names, but they have a group of individuals who help make investments, find really good investments, negotiate investment deals with companies. You can see here that some of the individuals at Kleiner Perkins work in areas of focus. So this team here makes investments in an area that they refer to as digital growth. And you can see we have different teams associated with Kleiner Perkins that do a bunch of different things. Kleiner Perkins does have some very high-profile individuals that work as advisors, including individuals like Colin Powell, Bill Joy, who was an instrumental figure at Sun Microsystems when they invented a language called Java. Ray Lane, a very, very high-profile technology leader. So lots of very well-known individuals actually happen to work at Kleiner Perkins. So Kleiner Perkins, again, an example of a private venture capital organization, and these are the people who are making the investment decisions right here. And then these are the companies, these are some of the companies that they invest in, right? So these are companies that Kleiner Perkins has placed money into. So Kleiner Perkins eventually became then one of the owners of these companies. Let's just give you an example. With Google right here, Kleiner Perkins teamed up with another venture capital organization named Sequoia Capital, and they gave a combined total of $25 million to Google when Google was a small growing company. In exchange for that, they each received 10% ownership in Google. So Kleiner Perkins invested $12.5 million in Google and received 10% of the total stock in the company. Well, Google today is worth over $400 billion. So that gives you just a sense for the amount of value that Kleiner Perkins created for their own investors by making that investment in this one small high-tech company. And you can see here just kind of a look at some of the other companies that they've invested in. You may recognize some of them. Kleiner Perkins is considered to be one of the most successful venture capital firms in history, and they have a reputation for being able to place investment dollars with companies that have gone on to become very, very successful in their own industries. So that's just a look at a VC firm or a venture capital firm. Venture capital investors tend to look for companies that have very high potential returns, but that have relatively low risk compared with those returns. If there's anything that the venture capital group can find that will indicate to them that the risk is being somewhat managed, that makes them feel better about making an investment. They typically look for investments that fit within a specific range of characteristics. Most venture capital firms will say this money is going to be invested in companies in a specific industry or companies that are in a specific stage of company growth, or perhaps there are other characteristics that they would apply. Some venture capitalists really do prefer to come in and give money to a company in later stages of its growth in order to eliminate risk. There are many venture capital groups, however, who are willing to invest in a company in an earlier stage of growth in order to get higher potential returns. And there are some that are willing to invest all the way through the stages of a company's life cycle. Finding venture capital groups is relatively easy. There are quite a few organizations out there that list them. All venture capital groups seem to have their own websites. They're pretty easy to find. There are all kinds of places that have lists of them. There are associations for venture capital groups where VC groups will, put themselves on a list and everyone can find them. There is a national organization that does track the industry. It is called the National Venture Capital Association, or the NVCA. This is their web address right here. Demographics and statistics and investment dollars and other data in the venture capital industry are tracked by a couple of different entities. Venture Economics is one. Pricewaterhouse, the accounting firm, actually has been contracted by the NVCA to try to compile data on the venture capital industry. And so Pricewaterhouse actually has a lot of information about the VC industry. So there's quite a few places that you can go to find out about venture capital. Typically, when a venture capital organization is ready to make an investment or goes through an investment, they would start by reviewing a business plan and then doing something called due diligence. What that means is they will look at everything of a potential investment. So they'll look at the company's financials, but also at their customers and all of the agreements which they have signed. They will look very carefully at their employees and their strategy and their products and services and try to come up with their own evaluation of the potential success for the company. At some point, if the venture capital group wants to go ahead with an investment, there will be a valuation placed on the company. This usually involves some negotiating. And so, for example, if Kleiner Perkins were the venture capital group and they were trying to decide how much Google was worth, they would hold a negotiation of some type with Google's founders and owners, and then they would say, okay, we feel that your company is worth $250 million. And then based on that, we're going to give you $25 million in investment money in exchange for 10% ownership in the company. So they would go through the process of negotiating all of those terms. Eventually, you would close the deal, which means that the money is given from the venture capital group to the company. And then the venture capital organization will involve itself for the remainder of the company's lifespan in helping to manage the company in whatever way is appropriate. Usually, venture capital organizations will serve on the board of directors of any company that they make an investment in. That's very, very common. And they will try to offer advice and, in many cases, many other resources besides money in order to help the company, because they have a vested interest in having the company be successful. At some point, usually these companies will go through an exit, which means they are acquired or they become publicly traded, and that is normally the point at which the venture capitalist will remove himself, or the organization will remove itself from being associated with the company, and they'll do so by selling their shares. When a venture capital organization looks at a company as a potential investment, they look in great detail. There is a lot of information that the venture capital team usually requires, and they're very, very thorough. Venture capitalists typically bring a lot of resources to bear on a company that they have invested in, besides money. So besides just giving you money, they can help your company with strategy. They can help you make key decisions. They can help recruit key employees to your organization, and they can help you with partnerships and accessing distribution channels, and they'll serve on your board of directors. Venture capital organizations tend to be very experienced in certain types of transactions, and they are very, very helpful when it comes time to do certain things. For example, if your company, let's say you're working at a company that has received venture capital funding, if your company receives an offer to be acquired by someone else, your venture capital organization can be very, very helpful in helping to negotiate that deal and helping to make sure that the transaction is done properly. Some people worry about involving venture capitalists with their company, and the biggest concern is usually that the loss of control. The reality is this really depends a great deal on the position of the venture capitalist and the position of the company founders. If the company is in good shape and has lots of negotiating power, they can usually structure a deal in such a way that the original founders maintain control of the company even after receiving venture capital funding. Many venture capitalists, in fact, prefer not to have majority ownership in these types of companies. And so, this can be, the control issue can be a problem for some companies, but for many it's just a non-issue. If you are at a company that's trying to secure funding from a venture capital organization, there are several things that you can do to increase your odds of getting that funding. The first and most important is that your company should be involved in a very high growth industry with lots and lots of potential, because that's what attracts venture capital investors. You should make sure that your business plan is really clean and that you are building relationships with the types of venture capital organizations that you feel have the resources that will help your company. Making sure that the venture capital group fits with your company is an important thing. If you're able to generate revenues, that helps increase your valuation so that you get a better deal when you receive money from venture capitalists. And you want to make sure that that VC organization, the venture capital organization, is able to do a lot of things for you besides give you money. It's a very, very important thing. So venture capital is a very important source of funding for many, many small and growing private companies in our economy. And this is just a kind of a quick snapshot, of what the industry looks like.